Hi there, everyone. Welcome to another Ainslie's Gold Silver Standard Insights. And if you're new to the show, welcome too. I am Joe, your host. And as always, we have Chris Tipper here to break down the morning's news, which is posted on the Ainslie website. Joining Chris today is Tim Kent from Kent Private Wealth. Now, we've had Tim on the show a number of times before. Really good to have you back, Tim. But as we say, when Tim is always on the show, he is a financial planner licensed through Sira Group. But anything he says here today, of course, isn't financial advice. Do your own research. You all know that stuff. So, interesting story. Overnight, of course, out of the US, we've had the CPI, the Consumer Price Index, released, and it was slightly higher than expected, but the market didn't take it very well. So today's topic is entitled, Wall Street Crashes Most Since COVID Crash, Hot CPI Missile Strike. All right, straight over to you, Tim and Chris.
Thanks, Joe. Well, what a night it was. In the lead up to the inflation print, markets had been looking at the potential for the Goldilocks scenario where we achieved the seemingly mythical soft landing. It was all going so well. Inflation appeared to be slowing down, according to some of the early economic indicators. The market was starting to believe that the tightening of monetary policy was the fastest and, it was the fastest and sharpest rate rising cycle in history, and they were starting to believe that actually worked. And people were starting to look to a future beyond peak inflation and beyond terminal rates. Then it all came crashing back down to reality with a hotter than expected CPI number that sent shockwaves through the markets, resulting in the biggest single day broad-based market sell-off since the COVID crash. This was certainly one of those pivotal market events that we need to understand, as the consequences can establish the theme for the months to come. So to help us break it down and work out what happened, what it all means going forward, and how we should interpret this through the lens of our investments, we're delighted to have Tim Kent from Kent Private Wealth back to discuss this significant news and response. So thanks for joining us again, Tim.
You're welcome. Hi, Chris.
Hi. First question, let's start with the numbers. The market was expecting a 0.1% fall in inflation, but the result was a 0.1% rise. These aren't exactly huge numbers when the headline was 8.3% figure. So we're not talking about a very big difference from that, but the market response was swift and decisive. So what was hidden in the breakdown of that headline number that caused such a large and broad-based reaction?
Oh, I think it was a case of the market was expecting, like you said, the inflation number to come in. I think there was positioning for the inflation number to come in lower. So the market was looking and focusing on the fuel prices and commodities, and they had fallen. So there was an expectation that it would be lower based on those inputs that had fallen. And also supply chains had loosened. So that was obviously a positive, but the market underestimated rents that had started to surge. And also, I think the real thing the market was worried about was that obviously service inflation with obviously hotels, travel, that was still staying strong, but also core goods was a surprise to the upside. So given they are staying robustly sort of high, the market's worried about inflation feeding into the economy and becoming more, I suppose, sticky. And that was the big thing, is that it's sort of now starting to spread deeper, which was the Fed's biggest fear. Well, is a fear, and then that is now becoming the market's fear. So I think the market was correct how it reacted, and the market just got positioned very wrong because of their expectations, or that everything was going to be fine, and then it wasn't. And like you said, it wasn't a big thing, but it was what made up that inflation number becoming sticky parts of it starting to happen. But there is an argument that the market is looking, or those inflation numbers are backward looking and not forward.
Yep.
But when you've got positioning how it is, people are going to react quickly.
This morning I was talking to someone else who had mentioned oil being down, expecting, like, from their thoughts, they thought it would be a bigger dip, or that would have been leading to it. So if you've got oil lower and you've still got those sticky inflation numbers, like you said, that's probably not a good setup, is it?
No, it's not, obviously, no, because like I said, the rents are starting to run, and obviously, and also secondhand cars, their prices have come off a bit, but they're still higher than stubbornly high, I suppose.
Yep.
But yeah, it's just feeding into core goods now. Going to the shops, those sort of core washing machines, those sort of things are not coming down. So,
and things none of us can escape either.
Yeah, exactly. So those sort of things are now starting to feed, and that was that process. I think it's that process of, oil's come down, and that's that's, but that's a part of it. It's not everything.
Not everything,
Yeah.
sure. So where does that leave us in terms of the next rate rises? So a lot of this market reaction is really, at least from my perspective, is based on anticipation of what the Fed will do next. So you would think 0.75% is a certainty next week now.
Yeah.
But does this give the Fed room to actually go even bigger? Could they go a full 1%, for example?
Yeah, look, obviously that you can see from data if you're watching it overnight that, there is a pricing. I think it's only about 20% pricing of 1% potential. And look, if you look at what Canada did back in July, they increased by 1%, which the market was a little bit shocked by that, but they were sort of playing catch up. I honestly believe the Fed will still stick at 75. If they go to 1, I think it's a case of that it will potentially scare the market. So they want to increase, but I don't think and that would still take it to around 3.25 at that, they put bands that they have, but so it's getting up there. So I think they stick with 75 basis points. If they go 1%, if the market is shrugs, bounces back tomorrow and rallies back and sort of brushes it off because of some other commentary, maybe the war starting to come to an end, and that might be a positive for the market, might start to think, okay, that's going to free up supply chains even more. And look, the market puts a positive tilt on it and it rallies, and then the Fed might go, okay, we can do 1 and we won't create too much of a meltdown in the market and asset prices. I think that's the only reason. I think that's the only reason why you could see 1. I think 75, if things sort of go along how they are, the bounce around now, we've had that major pullback. It might pop up a little bit, come back, but sort of chop around, go down a little bit more, but not do anything dramatic. I think 75 would be what they'll go with. But there's always the chance if things shape up how they want
Sure.
to.
So I just want to dig a little bit further into a part of that response there, because what do you think, or can you elaborate on what you think about the market's response? Because that was pretty big. So significant sell-offs of the S&P, the NASDAQ, markets all around the world. We're still experiencing that today in Australia. Some of these were the biggest crashes since the middle of the COVID crash. So based on what you're saying there, do you think that's a bit of an overreaction on that number or not?
No, I think the market's really just given back what it's rallied in the last 6 days. So
Sure.
I think it's just unwinding the rally that went in expecting a strong number, a soft number, a soft inflation number, and showing that the trajectory was down, and obviously the trajectory sort of bumped back up again. So I think the market is correct. It's unwound, and in Australia today they're doing the same thing. It's unwinding back to that about 6 days ago when crypto started running, and then the rest of the market started to run on the back of that. So I think the market's right. Going forward now, where we go, have another leg down, keep drifting lower, will depend on sort of, I think, market positioning and sort of commentary out of maybe if companies come out and start saying, oh, things are okay, demand's still there. So while I think demand is still strong, you saw overnight Visa, MasterCard sort of talking about how they're not seeing, and also Bank of America, they came out and said that demand is still quite strong. So I think it potentially chops around here. But if that demand, the market's going to be a forward sort of guide. So they might start to position as in market fall further in the short term because of the thought that that demand will eventually slow. But it depends on how the market takes and also positioning was very long. Those have been unwound. This is big fund managers, so big money. So that's unwound now overnight. Maybe there's a little bit more to wash through. So I'd expect a stabilization, maybe another 2% down, but a chopping around now until demand or the market takes the view that demand is going to slow.
So I think you've probably already answered this, but I'm just going to dig a little bit further on one angle with that. There was a graphic in the news today looking at comparisons with 2008, the global financial crisis.
Yeah, I've seen
so
that.
when you look at some of those charts and you overlay where we are today, it's pretty concerning. But I get the impression that you don't think that that's a fair comparison.
Well, it's tracked it pretty closely, so I don't know what scale they're using on those sort of things, but I am watching it and conscious of it. Look, I think looking at percentages and trying to position portfolios, I give it about a 20 to 30% chance that we have a GFC type event and something negative. I mean, there are obviously there's a lot of negative things you could argue happening out there, but there are also positives in regards to balance sheets and equity value that consumers have got. So I think I'll give it a 20-30% chance of happening. I think my base case, our base case is that we have a sort of mild recession. I think the market overall potentially falls in the US, tests those lows, potentially goes lower around that 3,000, 3,400. So a 30 to 35% pullback in total. Obviously, if we have a GFC type event, we're talking 55%. Well, if we're in line with the GFC 2008 type event. So I give it a mild. I think the Fed can pivot, but it'll all come down to, and investors need to understand, it'll come down to how stubborn that inflation is. And if it remains high and doesn't sort of slow, then they will keep raising. And that's going to then, it's going to slow economies. And how that spiraling effect happens in credit markets and what is sort of positioned poorly, and if that starts to blow up, then you can get it. So if inflation next print's better, and and there's data showing that, and the economy starts to slow, and there's just everything starts to sort of, China starts to loosen up, and you get that, then I don't think you get that big event. But I'm not discounting it. I definitely, we are positioned very conservatively, the most conservative we've ever been positioned in the 22 years I've been doing it. So, but I'm thinking it's a possibility, but I think base case is still a 30-35% pullback is significant.
Yeah, but it's not necessarily
painful,
GFC.
no matter. Yeah, it's not a GFC, but I'm not saying, like I said, I give it it's not a sure thing that it's going to follow that, but yeah.
Sure. So, and you've sort of answered this about how you position there, and probably that reflects on how we can position ourselves in this scenario.
Yeah.
I know at Gold Silver Standard, we always preach diversification.
Yeah.
And I'll probably like to ask about that, if you think that's the right play here a little bit more specifically. But there was a really interesting line in the news today talking about uncorrelated diversification, where you try and protect yourself in uncorrelated assets. So a traditional balanced fund simply won't provide that sort of protection when you've got broad-based market sell-offs. So how do you sort of think about that?
Yeah, that's and we've been caught a little bit. We sort of moved heavily into bonds, and they've sort of correlated to a degree with the market, not totally, but there is a sense of correlation, because rates have gone up more than we'd anticipated. We thought they might go up to around 3%, but the bond market's pricing in 4% or 3.75. So we've been a little bit caught there, but now things should start to play into our favor, because the rates are going to start. I mean, there's always a bit of a lag. And that's why I think the bulls are probably pushing back, saying that the Fed are going too far, and that applies to Australia as well, that they're moving too quickly, and they're not allowing for things to adjust in the economy from a demand perspective. And that's happened pre-GFC. I remember, back in the GFC, the RBA raised rates when everything was sort of going, they increased interest rates to over 7%. At that time, just as things were starting to go pear-shaped. So they have got a track record, central banks, of raising too far. And that's obviously, we think they're potentially going too far, because I don't think they can get to 3.75 to, they're talking 4% in the US. That's a long way up, and that's a high. You're talking 6.5 to 7% on a variable loan, which is that's got to start.
And we've talked about that on this segment before, because it just at some point becomes unsustainable. You tank, like people simply cannot afford that.
Something's going to break, and you're going to have a slowdown, and then bonds are going to rally because economic growth. They're going to be positioning for interest rates being cut. So we're heavily in bonds. That hasn't been great. It's been all right in the last 3 to 4. It's played out fine, and it's playing out well today. They're down a little bit, but I think I'm comfortable there. Obviously, floating rate notes. Obviously, gold, we've got probably our biggest position since 2008. 2018, we had a very big position in gold. We traded out of it, and we're back into it now. And we're still, and it's quite a big position, and we're comfortable with that. Just looking at how it's played out in previous downturns, gold's always traded either flat or up during a sort of a market correction. So we're comfortable there. Equities, look, if you're in equities, you want to be just focusing on quality and moving towards there until you get some sort of clarity. So it's equities are difficult. And like you said, from a balanced portfolio, in the last 12 months, you've had equities down and you've had bonds down. But I think
which is
I'm
been a double punch.
That. Yeah, I'm expecting that. Like you can't have everything in gold. You're going to have that correlation, I think, is going to start to break down. So you can have, there is other options, and obviously term deposits provided. Now they're providing a return on your capital.
Actually getting a yield. Yeah.
Yeah, you're actually getting a yield. So you just want to be really careful what you're going into, because things may start to break in areas that people had anticipated in that debt market. If you're trying to chase higher yields there, you'd want to be careful. So, but yeah, gold provides a good. Silver's obviously much more volatile. We haven't played there, but it's up to the person.
Yeah, absolutely. Well, thanks again, Tim, for coming on to break all this down for us today. We seem to be, from my perspective at least, at a really important sort of juncture for the markets right now. So it's always good to hear from trusted and balanced voices, and you always offer a balanced voice there about what to expect and how to position. So we'll look forward to our next chat as we see how the next leg unfolds.
Yeah, you're welcome.
Great. Thanks a lot, Tim.
Thanks, Chris.
Brilliant insights as always. Thank you so much, Tim, for being on the show. Chris, I'll see you on the next one. And if you, the audience, would like to continue the conversation with Chris, right after this video is uploaded, Chris will be on the Discord channel. So head over to discord.gg/gold. That's discord.gg/gold to ask your questions for the next sort of hour or two after the video is uploaded. Of course, I always want you to like, share, and subscribe to the Ainslie Bullion YouTube channel, youtube.com/Ainslie Bullion, and also check out goldsilverstandard.com. As always, as we say here at the end, balance your wealth in an unbalanced world. Take care. We'll see you next time.